personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us on a weekly basis as we bring to you the interesting, fascinating, and ever-changing world of mortgages, mortgage pricing, as well as real estate news in the Inland Empire. The IE, we love it out there, and I know you're baking under this sun. Wow, it got hot quick, didn't it? And some of the things that we are trying to deal with around that, whether it be can you get proper home insurance. We've talked a lot about that on the air, and we have an upcoming guest in a couple of weeks to do with that, a guy from the insurance agencies. Guy's been dealing with it for a long time. Very interesting, but we'll bring you that in a couple of weeks. Also, I think in what we try to do each and every week, bringing to you the information about not only these kinds of sectors, but the rates, why they go up and down. It's interesting because, again, we have interesting news today out that the unemployment rate has gone up, yet we have a massive amount of people who have been hired last month in the month of May. So there are a lot of conflicting signals in the economy, and when we bring that to you, what does that mean for you? Because you're trying to buy a house, or you're trying to refinance a house, or you're trying to take the equity that you have and turn it into some money-making scheme, whether it be buying a house and renting it out, whether it be getting into a business. All of these things are important, and so we're going to get to it. However, if you want to see and hear me on a daily, weekly basis, and you can't tune in to KCAA Radio on Saturday and Sunday, go to YouTube. Jeff Barton, the Mortgage Voice, is the YouTube channel that we are on YouTube. YouTube is a great place to get almost anything you want. With ChatGPT, you can look up all kinds of fascinating items, and they'll give you a lot of information. However, on YouTube, they probably have a video on it. That's how massive and great that the people at YouTube are getting, and we're certainly there too. Jeff Barton, the Mortgage Voice. We're also on, as I said, KCAA. The people down there, they come to you and me every week, and we bring you a great show, and I'm really thankful about that. Let's get right to it. Oh, before we even start, there is a tremendous amount of anxiety because of this election coming up. And there are people who will stand in front of you and shout whatever they're going to shout about whoever they back or whoever they hate. The economy itself is always at the center of all of these arguments, because if you're better off today than you were 4 years ago, that's the saying. Well, just so you understand that we are pretty much treading water for the last 10 to 15 years in terms of the type of economic growth we have, regardless of the claims of the people who are, in charge of the country or in charge of the economy. So, okay. So before COVID, there was Obama, then there was Trump, then there was Biden, right? So during the Obama administration, during his 8 years, he averaged 2.33% in gross domestic product, the GDP. And that was for 8 years. So that's Obama's legacy. Wasn't great, wasn't terrible, but it was steady, long-term growth. As you remember, during that time, he had just come out of the 07 and 08 crash, the mortgage meltdown, they called it. Okay, so that's where we are in terms of Obama, 2.33% for 8 years. We came to the Trump administration, and this just before COVID. We won't include COVID, we'll mention it, but before COVID, Trump's economy was growing at 2.67%. So roughly, 40 basis points better than Obama's. And as a result of the long, steady growth, the policies that President Trump had boosted the economy by 40 basis points. Not a lot, not insignificant, but really in the same line and in the same vein. Now, if you throw COVID in there, which nobody can because it really threw a monkey wrench into anything we're talking about in terms of the economy today, actually, and today, 2024. So the percentage of growth including COVID, is 1.45%. So that's what I mean. You can't really include that, right? So if we have Obama at 2.33%, pre-COVID, Trump at 2.67%, now you throw Biden in there. Now, Biden's numbers are also skewered because you can't really go pre-COVID because he was post-COVID. He was the guy after COVID hit, and he came in. And anyway, his particular growth over the last 3.5 years, or 3 years plus, is 3.4%. So as you can see, the amount the economy has grown during the 12 to 15 years pre-COVID, through Obama, through Trump, through Biden, is not all that different. And so when we talk about the economy and how the economy is affecting you, most people would say that it's bothering them because prices have gone up, inflation. And inflation has been driven by many different factors. The main factor is too much money in the system, right? That's what everyone says. Too much money in the system. You can't print money, give it to people, and have prices stay the same. You're creating too much demand with the money you're giving people, and therefore what happens is people are willing to pay more for products that are scarcer, and even general commodities are scarcer. So I went searching this week and looking around through all kinds of things in the marketplace in regards to this. Now, everybody knows that I drive around in my car and I eat at gas stations. That's just, I don't know, anybody who's in their car a lot, that's what we do. We drive around, we get a Coke, we get a snack, and we keep on driving. And I've been doing that for, 30 years since I've been in Southern California, especially since most of my work is traveling, driving around, seeing clients, or now I'm in the medical world doing the same exact thing. So the snack business itself has really been hit because of the rising in prices. Now, during the State of the Union, we had Biden talking about shrink inflation, i.e., you're paying the same money for a product, but there aren't as many Cheetos or potato chips or whatever it is you're buying in the bag. That's one way that inflation affects. The other way, of course, is what are the companies making these products and how are they doing in terms of their business models? And because snack business is supposed to be recession-proof, supposed to be inflation-proof, i.e., if you're hungry and you want a Twinkies, you're going to pay anything you want because you're in the convenience store, you got nothing else to eat, and that's what you're going to buy. So 2 companies come to mind quickly. Obviously, the companies that we're talking about are Campbell's, yep, and what's the other one here? Hold on a second. I have it right here in my notes. Well, Campbell's is one. Anyway, their business has gone down 1%. And PepsiCo, there it is, which owns, these 2 companies are massive in the snacking business, but their business is down 2%. And what it says is that the general person who's driving around out there, who, as I can tell you by the numbers in the economy, is really not that affected by either the job loss, which hasn't happened, or pay being cut, which also hasn't happened. What has happened is the things that you deal with on a daily basis have gone up dramatically. I was at Starbucks. Now, granted, I'm at Starbucks, right? I'm the person on the coast who goes to Starbucks to buy a cup of coffee. $4.75. $4.75. And I said, wow, that's a very good cup of coffee you have there. They laughed at me and they said, I know, it's not us. Now, granted, that was an in-store Starbucks, so you can't really, that's not an independent store. But in the Valley, $3.25 to $3.50 for that same cup of coffee. Seems like the gas prices, right, have just gone up and stayed up. Doesn't make sense to me. California has its own gas and its own refinery. Why does that happen? But these things that I'm talking about affect the general populace. And that's why when you hear people say the economy was better in the past, I'm, looking backwards as if somehow in the rose-colored glasses that we look at things when we're, fawning over what it used to be, and we hear a lot of people do that about many different things, but about the economy in particular, these nuisance items are why. In general, food has gone up, shelter has gone up, and obviously gasoline prices and all the other things that we live with have gone up. But so too have your house price, i.e. gone up about 30 to 50% over the last 3 years. If you're invested in the stock market, and many people are, that's gone up tremendously. We had, again, today, record-breaking stock market numbers, whether it's the NASDAQ or whether it's the Dow or whether it's the Russell or whether it's the bond market, all doing exceptionally well. And, of course, if you're employed, your wages have gone up about 4% over the last 12 months. So inflation, yes, but it has also seen things that are inflated that are good for a majority of the people who own homes doing very well. So it's a kind of a mixed bag on that. I hope that confused the heck out of you. I didn't mean to, but again, I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us as we bring to you the best news possible about the mortgage and real estate business. We talked a little bit about in an earlier section about what's happening with the economy over the last 10 or 15 years, so people get a little bit more relaxed when it comes to crazy season, which, of course, is the election. Anyway, I am Jeff Barton. This is The Mortgage Voice. If you want to see us and hear us, go to Jeff Barton, The Mortgage Voice on YouTube. We also have a great website. If you want to go there, see past guests, as well as a way to get in touch with them, it's themortgagevoice.com. And we are on a number of different podcasts. Daryl, you got that?
I sure do, Jeff. It's Apple Podcasts, Google Podcasts, Spotify, Spreaker, Stitcher, iHeartMedia, Odyssey, YouTube, podclips.io, and themortgagevoice.com.
Excellent. Podclips.io, great place to centralize your podcasting needs. If you want a great, there's a variety of different things there. I want you to go there, podclips.io, and seek out and look and listen to a bunch of different great people who will bring you some interesting and fascinating looks at their particular industry, whether it's in healthcare, whether it's me in financial, whether it's alternative dispute resolution, whether it's sports or lifestyle. There's a great place for you if you go to podclips.io. Again, I'm Jeff Barton. This is The Mortgage Voice. Let's get right to it. 30-year fixed-rate loan is at 7.15%. 15 years at 6.60. The jumbo is at 7.37. The FHA is at 6.64, and the VA is at 6.65. The 2 years at 4.866, and the 10 years at 4.42, and that spread is about 40 basis points thereabouts. Why have we not talked about the inversion in so long? Anybody who's listened to the show for the past few years knows that this inversion, i.e. the 2-year, is paying more than the 10-year. That's called the inversion curve, and why that hasn't been talked about much in the news over the past 2 or 3 months. Reason is it used to portend a recession. Well, now they've given up on that. Why? Because after a year of crying wolf, most people would be like, you know what, the wolf's not coming. So that's essentially what they're doing, and I think the jobs report that came out is a great indication of that, with adding 272,000 jobs in May. It tells you that the economy is still rolling along pretty strong. There are indications that a number of different places in the economy have come back to earth, i.e. pre-pandemic levels. And that's a good thing, because what we would like to see is inflation join those groups of economic indicators at 2%. And that would be good for you, because we would have the Fed lower their interest rate, and then we would tangentially have the mortgage interest rates come down. I wanted to get into a little bit of that. Now, this is an explanation that you may or may not be able to follow, but anyway, I will try to get it to you as clearly as possible. Okay, so we always talk about the Fed rate, and then we talk about the mortgage rate. But so many people think they're the same thing. They're not the same thing. So when people say, hey, the Fed's got to lower the rate in order for mortgages to go down, that's partially true, but it's not 100% true. The reason mortgage rates are high, one of the reasons is, yes, the Fed rate is at 5.25 to 5.75%. That Fed rate is what the larger banks borrow from the Fed in order to meet their liquidity requirements on a daily basis. So if they're short $100 billion of the liquidity requirement they need today, they have to go to the Fed and borrow it, and they're borrowing it at that particular rate, either 5.25 to 5.75, depending on the demand, depending on the agreement with those member banks. That's how that particular aspect of the Fed monetary policy works. Now, as the Fed raises that rate, what happens? The banks that come to the Fed on a daily basis to borrow money to make up that liquidity, they have to pay more money I mean, it's obviously during COVID, you had 0.25%. Now you have 5.75%. Obviously, you're paying an additional 5 to 5.5% in interest on a daily basis. And when you're talking in billions of dollars, that's a lot of money. And most of that money is money that used to be lent to you, the consumer, either through credit cards or mortgages or car loans or any number of other business-related activity. Now the bank doesn't have it to pay to you because they're actually having to pay the Fed. So what that does is it takes money out of the system. Now we've been in this accelerated market of rising interest rates at the Fed for, we're going on close to 2 years, right? Let's say it's 2 years, year and a half to 2 years. What that means is we've been sucking money out of the system for that long. So because of the fact that we printed so much money during COVID, rather than giving it to the larger banks as we did in the Great Recession in 2008, this time around we flooded the market with, not the market, but we gave people money. I don't know how many $1,200 checks. How many was that? 3? I think everyone got 3 $1,200 checks. Then there was the PPP program. So there was a lot of money, trillions of dollars of money in the system. I think at the end it was close to $3 to $4 trillion. Now to get an idea of what $1 trillion is, think of $1 million and a stack of money and how high it goes. Top of the Empire State Building, right? $1 billion would stretch to the moon. $1 trillion probably go to the sun and back. So that's how much, in terms of a visual, that we're talking about when we're talking about these particular items. So when I got to thinking today, I said, you know what, let me try to explain this a little bit about how it really works and why these numbers mean what they mean. If you're lending money to anybody, you want to make money on the interest. It's just the way it is. It's business. It's the way it is. So if I'm going to lend money to you, I'm going to charge you X amount of dollars. When you finish the debt, you're going to pay me either that interest in one lump sum or you're going to pay over time like an amortized loan. That's really the way it works. The rate itself that we charge you is based on how cheap the money it is to me that I buy, that I get. But it's also based on the person that I'm going to take that product, i.e. the loan that I gave to you, and sell it to somebody else. Because this is not George Bailey's savings and loan. Back, anybody that doesn't know what I'm talking about, you can look it up. Because most banks, all banks, now maybe there might be some credit unions that keep the money, but they don't keep the loan that they make to you and service it and wait 30 years till it's paid off. They don't do that. They take this product and either sell it to the government agencies, Freddie Mac, Fannie Mae, Ginnie Mae, or they sell it to a private investor. Sovereign fund, what does that mean? Countries buy U.S. mortgage-backed securities. That's just the way it is. So countries buy it, hedge funds buy it, Wall Street buys it. There are so many different people out there with a lot of money who want a steady rate of return on the money that they have. So they go out and they buy mortgage-backed securities, and that's how that particular part of the business works. So the mortgage market, through the banks, through the lenders, gets replenished by selling the product to somebody else. When you sell, you're going to sell to the highest bidder, right? Makes sense. Everybody knows that in order to make money in any market, you have to let as many people know that you're selling a particular item, and you let that item fluctuate, i.e., so you'll see on a daily basis, mortgage-backed securities will go up, will go down by hundreds of basis points. Now, if you're talking about one loan, it's not that big a deal, but when you're talking about billions of dollars of loans, that is a big deal. So now we're talking about the Fed, who is taking money out of the system. Now we're talking about the mortgage-backed securities, who are looking for the highest bidder. These numbers matter. The rate that you pay on your particular loan is how it is determined whether that particular loan can compete with what mortgage-backed securities are going to sell for and the treasury bonds are going to sell for. They're competing with each other for your dollar or for the investor dollar, who forever is buying those two instruments. And because the Fed has got the rate at a certain amount, the amount of money that's available to purchase either the mortgage-backed securities or the treasury bond is less than it was previously, which is why what happens is you have less money to buy two different assets. So in order to attract the best buyer out there, you have to offer the most yield. And that's why you see treasuries going up. Treasuries on the 10-year, what are the 10-year? 10-year today is 4.42%. Now you're talking about trillions of dollars in mortgage-backed securities and trillions of dollars in the rate that they're going to charge in order to have the Fed look at both the mortgage-backed security market and look at the bond market. And both of these things are competing against each other for the amount of money that they get out of the system. So you have the Fed removing money from the system, two different investment vehicles, debt really, are being sold onto the American marketplace in all these areas. Now, what does this have to do with the rate? Okay, so the rate has to remain high because they have to compete with U.S. Treasuries in order to make the buyer well aware and obviously desirous of the most return on their money. So all of these things affect the rate, and you won't see the rate come down until you see the mortgage-backed securities in general and the Treasury Department yield come more in line with whatever the Fed has for their particular rate. So the Fed lowers it by 4%, you all of a sudden have an incentive to lower your rate. Doesn't mean that it's going to happen, but the incentive is to do that so that you attract more people to buy your product because it's cheaper. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Thanks very much. Be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show to listen to us each and every week as we bring to you the news that you can use. Most of the useful news that we bring to you are about programs from different lenders. The way we try to help is bring a global view, which is what I try to do on the first couple segments. Then we bring in experts in the industry to be able to sort through that and really give you choices that you can take advantage of. One of these people is Rob Rank, who joins us from Equity Wave Lending. We've had Equity Wave on once before, but not Rob, so I appreciate him coming to the show. Rob, how are you?
Good. How's it going, Jeff? Thanks for
it's pretty
inviting me.
good. Thanks very much, and thanks for coming on.
Yeah.
Okay, so as we were talking off air, the market has got some advantages in terms of products that you can be able to provide to consumers. What we like to see is an ability by which we can take the equity that's in your home and to be able to convert that into cash or some other vehicle so that, you know, the money that you've been making, although it's hard to tap into and access because of the lock-in issue. How are you guys helping in that area?
Yeah, the best way we help like people who are self-employed or who have investment properties. We can provide a second because a lot of people, they don't want to touch that first.
Of course.
Because those rates are so low. Who knows if it's ever going to get that low again?
No, not in my lifetime. No.
Yeah, mine neither. But we can help with that. We primarily do business purpose loans.
Okay.
So like someone who has a business and they have a lot of equity in their private residence, we can actually tap into that equity for them by providing a second that can get them the money that they need to expand their business or, acquire another business, whatever they want to use the money for.
Right.
Or like an investment property, they want to pull cash out to as down payments for other properties, other opportunities that they see, or maybe to rehab some of their properties to increase the value, that kind of stuff.
That's interesting. Okay, so you talked about a second loan. Are there TRID requirements in the second loan? It's a business purpose loan, so there probably isn't. But can you explain that part of it too?
With business purpose loans, it's not a consumer loan. It's just strictly used for business, so there aren't TRID requirements for that. It's treated more like a commercial loan.
Okay.
So there's no right of rescission and that kind of stuff, even on an owner-occupied property. But the funds have to be used for their business or for an investment opportunity that they see.
I see. So you can take money out of your home, but you have to use it for your business.
Right. Yeah. For the kind of loans we present, because we do basically, it's like a stated income,
Sure.
stated asset. We don't need to see tax returns because, I mean, we know how a lot of self-employed people are who own businesses. You take all the tax deductions that you can get.
Of course.
So a lot of times you don't show, a lot of positive cash flow, even though you are cash flowing.
Right.
So.
Okay. Okay. Let's get down to the nitty gritty. What kind of credit score do you need? What kind of equity do you need to remain in your property? These types of questions.
Yeah. Primarily, what we do with the seconds, we'll do a combined loan to value of 60%. We're kind of conservative on that because it's private money.
Sure.
We don't have a FICO requirement. We like to see at least a 600 score. But people have had some issues where the scores can go below 600, which is fine. We just need a good explanation, and we see that whatever caused the problem isn't there anymore.
And you're in second position on most of these loans. So how do you, I guess, guard against the issues of, people with lower FICO scores obviously have a lower FICO score for a reason. So how do you guys, do you deal with that by higher rates, or do you deal with that just by having that much equity in the property?
Well, we like to have the equity position, and the rates are a little higher. You could get a better rate if you had full tax returns, and you could go to your bank and get it.
Sure.
But we're a lot easier. You don't have to provide tax returns and that kind of stuff.
Is this more of a short-term loan, or are people taking these out for long-term? What are the terms in the loan?
It's just short term.
Okay.
Because we'll do like 2-year, maybe a 3-year.
Okay.
On an investment property, we can do it as an interest only, but on owner-occupied, we do what's called a 40-year amortization that's due in 2.
I see. So it's a balloon payment after 2 on this business purpose loan that you're borrowing money out of your house.
You can either refinance with us or someone else, or you just pay it off. Depends on what you use the cash for.
I see. And who typically is your client? Who is the type of person that will come to you for this type of loan?
It's someone who needs cash pretty fast. Their tax returns don't look stellar for the local bank to help them out.
Right.
It's that kind of stuff. Or they have lower scores, because they had some late pays on mortgage, or something happened.
Right.
Life happened. So that because we overlook that kind of stuff. We just want to know that whatever problem is, it's gone.
Right.
We're not providing like a bailout, or this money isn't to be used to pay off your credit cards, because we do look at that. Like if someone has $150,000 in credit cards, they're maxed out, and that's why their scores are low. It's like, well, what are you actually using this cash for?
I see. So really, if they have low FICO scores, it's probably due to a medical expense that you'd then say, oh, okay, I understand that one, but not the high credit score.
Yeah, something like that. Yeah, a lot of times that's what it is. The bread earner wasn't bringing in the cash for a while.
I see. Okay. Very good. And how successful has it been? I mean, a lot of people need to take money out, so I imagine it's doing pretty well.
We do a lot of loans. They do a lot of investor properties. People are taking advantage of that, their equity, and then small businesses that need the cash, and they can pull it out of their because they've gained so much equity in their primary residence,
right?
And they use it, and they have a plan usually to pay it back, because that's always the best thing to do.
Do you look at the ratio prior to COVID happening and the amount of equity in a property, or do you just look at it today?
We look at it today.
Okay.
There are some areas, I don't know exactly because I don't keep up with them all the time, but there's some areas where values have dropped.
Right.
So we're a little, we kind of look at them closer.
Right.
And we look at the appraisal and that kind of stuff and see what's going on in the marketplace.
Right.
A lot of the areas, especially Southern California, are still, really strong.
California's strong. I think the areas you're talking about are like Texas and Arizona, and there's one other state. I read about it today.
Yeah, we don't do seconds there. We just do first.
I see. And how is that market, the first market? It's a lot of competition, obviously, for fewer and fewer borrowers out there. It looks like, the amount of money.
Yeah, well, we do it for our first. We can do it for an owner-occupied if the property is free and clear and it's a business purpose. But mostly our firsts are for non-owner-occupied properties.
And you're in Southern California, and you're doing what other kind of loans here in Southern California?
Well, we do the first mortgages, up to a 65% LTV for purchases.
Okay.
We foreign nationals. We do some commercial, usually just like up to a 50 or 55% LTV.
And is that like a unit building or is that industrial? What is it?
It can be almost anything. It just depends on the property. Yeah, I don't make those decisions, unfortunately.
Right,
So
exactly.
That's one of our owners decide on the commercial.
Have you
because
found
commercial's
any?
a little more difficult.
No, I understand. Have you found any issues with your appraisals at all? I.e., you're having difficulty either getting an appraiser out to the property or getting the proper numbers that you need in order to do the loan?
I haven't personally.
Okay.
So I haven't talked to any of the other LOs about that, but I haven't had an issue.
Okay, so really, it's full guns ahead. The only problem is that rates are still terribly high, but that shouldn't affect your second mortgage business at all.
No, yeah, and
Right.
the seconds, the rates, it just depends on what their credit score is and what the LTV is, the CLTV.
Right, exactly. Okay, so, and you're in 50 states?
The seconds we're only doing in California, and I think there's 42 states we do with the first.
Wow, that's a lot.
Yeah.
Yeah.
It's either 42 or 37. I can't remember. We were supposed to add some states.
Now, you said you're of the same age as me almost, so you've been in the business a long time. You've seen things like this happen before, right? Rates go way up and business gets tough.
Yeah, it's cyclical. It's just, the Fed, like the Federal Reserve's trying to control the economy a little bit, to stifle inflation. Hopefully they're successful and they start going back.
Yeah, I hear you there. No, we were just talking in an earlier section as to why the Fed is always the one who's deemed the person that sets the mortgage interest rate. And I was trying to explain, well, it's more a confluence of different events, but certainly the Fed has a lot to say about it. That's for sure.
Yeah, they always control the money supply,
right.
And they think they can control it, but they always go too far one way and too far the other. They can never get it right.
Yeah, I wouldn't want that job at all.
They're human like the rest of us.
Right, exactly. Hey, listen, I really appreciate it, Rob, for coming on the show. Any way you can shout out a phone number so people can get in touch with you?
Sure. You can call me. I'm Rob Rank, R-E-N-K, and my direct line is 303-521-7622.
That's 7622. 303-521-7622. Is that right?
That's it.
Okay,
That's it,
excellent.
Sir.
Rob, thank you very much for coming on the show. I really appreciate it.
Yeah, I appreciate it, Jeff.
Okay, very well. We'll get back to you soon. Thank you. That's Rob Rink from Equity Wave Lending. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, listening to us on a weekly basis where we bring to you not only the best news, but the best people. A lot of people that we do bring on the show give real specific, and they detail out what the programs are. They generally give you a sense that there is hope that you can get a loan. Guess what? I know that it's tough out there, especially with rates the way they are, but there's a lot of different ways that you can get a loan, get a property, and be able to feel comfortable in doing so in this market. Rates always change, and you can always either reduce or increase your monthly payment on that loan. It just depends on who you go to, and the best people that we know come on our show and tell you about their programs. One of these people who hasn't been on the show before, and I really appreciate Elton doing that, Elton Wangs, I'm sorry about that, from New Wave, and he joins us now. Elton, how are you?
I'm doing great, Jeff. Thank you again for having me on the show. I have an opportunity to check out the Mortgage Voice, and I'm glad to be able to have this opportunity to connect to your audience.
Excellent. Oh, that's very good. Okay, so tell us a little bit about what New Wave is doing, what type of loans you're doing, kind of clients you're looking for.
Sure. So here at New Wave, we are a wholesale direct lender specializing in non-QM products and programs. We are located locally in Southern California, specifically the City of Industry.
Okay.
We started out serving local California, Golden State, and 3 other states, and now growing to about 20 plus states and counting. So generally speaking, we, like I mentioned earlier, specialize in the non-QM realm. And what non-QM is It's a product and program catered to clients who aren't necessarily creditworthy for the standard qualified mortgage programs, or situations where clients may have been transitioning through a life chapter, change in pay structure that just happens to fall in the timing that they're purchasing a home or looking to finance a home, refinance their homes. And we generally like to cater to those types of clients.
Okay.
Is our realm of expertise.
Hey, do you do mostly purchase, or I can know that refi is really not a big seller right now, but some of the lenders have branched out into seconds or other kinds of business purpose loans. Are you strictly doing purchase right now?
We actually are doing a majority purchase business currently.
Okay.
However, we do get refinance business as well. But it's, as you mentioned, with the current market environment, refinances aren't as popular,
Right.
As we would hope. But as you also mentioned, rates are ever changing. We're definitely hoping for that next refi boom.
Oh, yeah.
But,
Yeah, we all do well. But you know what? We've been trying to push the economy, at least a lot of people who talk about the economy are trying to say, hey, what we really need is a recession. And then, of course, everyone will do better in our business, as it always happens, because rates lower and then everybody wants to refi and take money out so they can sustain the lifestyle or at least pay their bills. That doesn't
Correct.
seem like it's going to happen, even though we've had this inversion in the 2 and the 10 for so long. How are you guys thinking about it long term? Are you looking at rates staying the way they are for at least 6 to 8 months, or what do you think?
That's a great question, Jeff. In the interim, our outlook in terms of market environment, we feel, even though feds and the government will tell us, they're talking about lowering and cutting rates again, we don't foresee that being something that'll happen at least not in the near quarter.
Okay.
Going into Q3 now, I think we're going to be looking at the similar average in terms of rates and what's available currently. Yeah.
Okay, so really what we're doing is treading water to and through the election, probably, which I don't know whether that favors one person or another, but I do know anybody out there trying to purchase a home is not happy because, obviously every percentage point more or less is going to cost them more or less money. So how are you dealing with that in particular? Are you just looking for a particular buyer that isn't really rate sensitive? They just need a way by which they can purchase?
That's a great question, Jeff. And how we go about it in terms of with our clientele, since we work with brokerages directly, it really depends on their book of business and what their clientele is looking for at the moment. We are seeing a trend in a particular program. I'm not sure if you're aware of it. It's called the DSCR, also known as the Debt Service Coverage Ratio Program. It actually originated over from the commercial side of the lending products and programs and trickled down into a way that got worked into the residential mortgage side of programs.
Sure. So explain DSCR. I know what it is, but maybe some in the audience don't.
Yeah, of course. DSCR, Debt Service Coverage Ratio, is a loan that takes the existing debt of a subject property and the rentability, market rentability of the property, and it offsets to its ratio to determine whether it's a positive ratio or a negative ratio, or not negative ratio, but a ratio of 1% or less.
Okay.
And what that means and how you calculate that is you'll take your subject property's monthly principal and interest payment, property tax, insurance, homeowners association, etc. You add it all up together, and then you take a look at the rentability in that market and demographic. And if that number, let's just say, for example's sake, it's 1,500, then your market rentability will, if it's 1,500 or more, your DSCR ratio will be at 1 or greater.
And that's what you want in order to do the loan?
You don't necessarily need to be at 1 or greater.
Okay.
However, it does have an impact on pricing.
Oh, I see what you're saying. So if the rents cover the debt, then the ratio
that's absolutely right.
The ratio that you get will obviously be a lower rate than somebody who doesn't. So you do lend on something that doesn't cover the actual rents. I mean, it doesn't cover the actual mortgage, right?
Yes, that's correct.
Okay.
If the rentability of the property is less than the expense factor of the home, it's still a considerable property and scenario that we can entertain.
I see. And do you look at, in a scenario like that, to have at least some equity in the property, 100%, or do you lend on? Or?
Yeah, we do have an LTV restriction.
Okay.
Our loan-to-value restrictions on that will vary depending on the client's scenario, and of course, the subject property and where they're looking at. But yes, there is a restriction. We can't do 100% financing. Generally speaking, it's 80%.
I see. Okay. And is there, I mean, I know in a lot of these DSCRs, there's no credit requirement. Is there on these ones that you're lending less than what the rents cover?
Great question. So there's a few DSCR products available. There is one that does have no credit requirement, but that's catered to foreign nationals.
I see.
Clients who reside out of state or out of country.
They don't have a U.S. FICO score, right? Of course.
Correct. Yeah.
Right. Okay.
Yeah. So that is a program or option available too.
Okay. And do you deal with a lot of foreign investors?
We actually do.
Okay.
We a good book of our business. I'd say we were starting out at about 5% of our book came from foreign national business, and now it's growing. It's nearing 30% actually of our book of business.
How is your company growing in this type of environment? It always fascinates me. I was in the mortgage business for about 30 years. Got out of it about almost a year ago, but it always fascinates me how companies in tough times seem to be able to put it together and grow their company, waiting for the next, boom year.
And that's a great question, Jeff. I mean, from my perspective within this company's outlook, I think their business plan and what's in place in terms of products and programs and flexibility, I think that's what their priorities are here that sustain such a good business model.
Right.
We aren't very risk adverse, but that could be a double-edged sword.
Well, yeah. I mean, if the market tanks all of a sudden or property values seem to go down quickly, it's,
We don't want to go down with it.
No,
Definitely.
Exactly. And so that's why I was asking you. I mean, obviously you're banking on the economy not only staying good, but also rates to go down.
That's correct. Yeah. Generally speaking, we are looking to grow beyond our current coverage, and we are doing a lot of outreach out of state, specifically towards the East Coast and the Midwest.
Oh, okay.
As we are licensed there too. You'd be surprised the number of brokers and clients that just aren't readily versed in the non-QM realm and these types of products that are available. So bringing those tools to their tool belt is what we aim to do.
That's excellent. Thank you for the information. Elton, we've come to the end of the interview, and I appreciate you coming on the show. I want to have you back, so thank you very much. Could you let people know how to get in touch with you? That'd be great.
Yeah, definitely, Jeff. And again, thank you for having me.
Sure.
I really appreciate the opportunity. You guys can get in touch with me directly at my number, which is 626-374-8267.
Excellent. Thank you very much, and thanks again for coming on the show.
Thank you. You have a great day.
You too. That's Elton Wang from New Wave. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us on a weekly basis. If you want to see the show, you can go to YouTube, Jeff Barton, the Mortgage Voice, and that's on YouTube. Been there for a long, long time. Hundreds of shows there. You can always just view what it is this week, or see what we've been talking about for the past 2 or 3 weeks. A lot of the topics we bring up on the show, we bring up again and again and again. The reason is because either the problem hasn't been solved, or the product that we're trying to introduce or talk to you about is something that really is helping a lot of different borrowers. We have many different lenders and people that come on the show, account executives for different lenders, as I said, and they bring to you the products available out there in the marketplace. Maybe you can consider them, maybe you can't. But if you go to the Jeff Barton, the Mortgage Voice on YouTube, or go to themortgagevoice.com, either one of these places, kcaa.com as well. They all have archive shows that you can listen to and look at, get a bit of a trend in terms of what's been happening over the last month, 2 months, 6 weeks, whatever it is, can help you in order to gain a perspective on the market. Okay, so in what we've been talking about all day on the Mortgage Voice is how rates are what they are, where they come from, why are they so difficult to predict, where the Fed is going to be able to help and hurt, and also let's boil it down really simply, okay? Let's look at a couple of house prices and what different rates would be able to afford them. The lower the rate, the less impact a rate of 6 to 5% is going to be. Let me give you an example. If you buy a house at $250,000 at 7% interest, which is currently what we've got going on, 7% interest, $250,000 house, the payment will roughly be $1,663. If you buy that same house at $253,000 at 5%, it'll be $1,342. Now, anybody who's looking at that can say, oh, it's about $300 difference in payments from 5% to 7% on a $250,000 house. Now, it's significant, but doable for most people. Now, let's just go to the top end. Let's go to $1 million house, which a lot of houses in Southern California, certainly San Bernardino and Riverside, have their share. And a lot of people want to buy those types of houses. But the difference between a 7% and a 5% is quite a bit different. If you're looking at a 7% mortgage at $1 million, it's going to cost you $6,653 a month. That's $6,653 a month. If you're looking at a 5% interest, it's going to cost you $5,368. That's a $1,200 difference. That's quite a bit different than the $250,000 example where it was $300 difference. This is about $1,200 difference. And in terms of rate, 7 to 5%, that's where we're talking about where we need to see the rates. We probably won't for quite some time. But just to give you an example of how rates affect your ability to purchase, this is in a, if you go to, I think it was on MSN.com, you can look it up and see this particular article, which talks about how rates are affecting and how the difference in the price that you pay for the house really is affected by the rate. The lower the house price, not so much. A couple $100, $300 is quite a bit different than $1,200. And $1,200 added on to, the $5,300 will get you that same house at 7%. And I think, if you're out there right now and you're trying to figure out a way to squeeze you into a home this, in this market, it's hard. One of the things that I wanted to say, though, is we see a lot more houses on the market. Let me just get to that. Yes, 604,922 houses available for purchase right now. And that is up 10,374 houses from last week. Each week I try to bring you that number so you can see how the expansion in houses available is really affecting the marketplace. And one of the reasons that we don't see more people jumping into the market is because of the rate, obviously, the rate and the price. I mean, we may see more houses on the market, but we don't see enough more houses on the market in order to lower the rate. The supply and demand just isn't there yet, i.e. we need more houses, obviously. Lower rates, higher competition for homes for sale. Well, that usually would be true, except in this particular market, what we see is a lot of people quit. I'm done. I don't want to do it anymore. I'll just rent. And we have seen rent prices come down in a lot of different areas, so that is a solution for many people, or just stay where they are. I know that in certain states we've seen an exodus of people, California being one of them, but not enough to say, hey, look, we have so many people leaving, we got to lower the house prices in order to try to keep them here. No, that's not happening yet. Okay, so a couple of things in the news to use section. I'll just run through it here for you. The net worth of households and nonprofits rose to $160.8 trillion. Let me repeat that. The net worth of households, that's you. You're listening to the show, you live in a household, and nonprofits rose to $160.8 trillion. These are numbers that did not exist. It's just mind-boggling. Equity in these homes rose to $3.8 trillion. And in real estate, $0.9 trillion. Okay, so you can see that as a result of house prices rising, stock market prices rising, that the amount of overall money that is now worth in your home, meaning if you are in the stock market and if you own a home, you're sitting pretty good, even though inflation is at 3.5%. And I constantly say, owning a home is the best hedge against inflation. Why? Because normally what you will see is supply and demand, like we have today, push the price of your house higher. How can you tap into it? We had a couple of guests on the show talk about it today, whether it's a second or whether it's a refinance or whether it's pulling money out for a business purpose loan, i.e. buying another property. There's all kinds of ways that you can take advantage of good inflation, house, stock market, wage, with your ability to be able to do that, to set yourself up for long term, set your family up for generational wealth. It's a great way to do that. Okay, a couple other things here. Okay, real estate, blah, blah, blah. Mortgage debt, right. Now, mortgage debt in the U.S., we have about 51 million mortgages in the U.S. It says it's $2.38 trillion. It's up 2.1%. From last year. That's a lot. The reason it's up, obviously, the prices are up, right? And that's how we get a rise in the amount of money that's owed. But $2.38 trillion is the amount of money that's owed in mortgages, and the household debt is up 2.9%. These are all interesting facts about what's happening in the economy. As we started off the show talking about the long-term, last 15 years, what GDP was, we're talking about how equity in your home, equity in your stock portfolio, if indeed you have one, and certainly wages going up 4%, 4.4% year over year. All of these things are good inflation, and as you can see, the GDP. The annoying thing is, yes, I buy snacks, and they keep going up. Gas keeps going up, and I think that getting a handle on that particular aspect is the last mile here, bringing us from 3.5% down to 2% inflation. I'm Jeff Barton, your voice in the mortgage industry. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
E-Digits. Lock them in for more information, recreation, and guaranteed fun. KC